Let's talk about it now with former Atlanta Federal Reserve President and CEO, and now Sam Nunn School of International Affairs at Georgia Tech, Dennis Lockhart, back with us. Dennis, great to see you. Thank you so much for being here. Give us your expectations for the jobs number this morning, and how important do you believe the growth in jobs will be for the Federal Reserve's decision on whether or not to raise rates down the road?
Well, I doubt we're going to see a blockbuster month the way we did last month. I think it was 336,000 was the jobs number. So I agree with the earlier comment. It's likely to be lower than that. But I think the overall conclusion the Fed is likely to draw is that they're seeing a rebalancing of the labor market and a slowing or a softening of the labor market only gradually, no deviation that's stark or dramatic. And so I think this report is unlikely to change their wait and see posture.
So what happened in the last month or so to the macro story in your view, Dennis? Because we know that we had the October ISMs out. Those are the manufacturing indexes and services. They showed a downtick in employment indicators. We also see that the labor market is showing signs of softening from the layoffs we're hearing, from the earnings season as well. What do you think took place in the last month to change expectations so much? And by the way, even the Atlanta Fed, okay, they were all the way up at 4.5% growth for the quarter, and now they're down to 1.2% growth on the Atlanta Fed now numbers. How does that happen?
Well, first of all, it's still early in the quarter, so don't take those numbers too seriously, because all that model does is accumulate data as it comes in. And it's too early in the quarter to draw much in the way of conclusions. Having said that, we do appear to be at something of an inflection point, coming off of a very strong third quarter, GDP at 4.9%. All expectations are that the fourth quarter is going to be pretty significantly weaker, coming down, a couple percentage points, but potentially in terms of GDP. And I think we're beginning to see the indications that narrative is probably correct.
Okay. I spoke with the Wall Street Journal's chief economics correspondent, Nick Timos, this week to get his outlook on the economy and the Fed's next move ahead of the decision. Here's what he had to say. Watch.
One tail risk I wonder about here, Maria, this economy has been so resilient. 500 basis points of rate increases, quantitative tightening going quite aggressively, a banking crisis in March, and it hasn't slowed down. So what if we get through this latest episode of tightening in financial conditions and the economy's still doing well? Does that suggest that we aren't talking about just one more Fed rate increase, but would the Fed have to do, several more? I think that's a tail risk for now. But it's one you sort of wonder about in the back of your mind.
What do you think, Dennis? How many more rate hikes are on the horizon from your standpoint?
If you can tell me what the future holds, I can probably give you a prediction. I really don't know. But the committee has not taken future hikes off the table at all, and I'm quite certain they've made no decisions about future hikes or future meetings. And so it will depend entirely on conditions. And I think the so-called tail risks that Nick is pointing out, that the economy just continues very strong, is very definitely one of the risks that we have to consider. And if the Fed is not getting the progress that it wants, it's not rapid progress, but gradual progress, they could quite likely move rates again higher.
Well, you would think that 11 rate hikes would have a serious impact on an economy that was facing 0% rates for so long. Of course, one reason federal officials unanimously voted to leave rates unchanged this week. 22-year high on rates, by the way. Chairman Powell left the door open, however, for another future rate hike down the road because he wants to get to inflation at 2%. How likely is that, Dennis? I mean, the Bank of England, by the way, also left interest rates unchanged yesterday. They're at 15-year highs. So we're talking at rates at elevated levels here, with still that hope, that expectation in the backdrop that at some point next year the Fed's going to cut rates. Do you agree that in order for the Fed to cut rates, it's going to be in response to a pretty deteriorating macro story?
Well, yes, I agree that they're likely to hold rates higher for longer than a lot of people would suggest. That sort of a tendency in monetary policy. They want to really be absolutely convinced that they have inflation under control, and that would bias them for holding for longer. And then cutting rates will be when they really feel that the balance of risks have shifted pretty dramatically to the downside in terms of the economy. And they really need to calibrate rates in order to try to avoid bad outcomes in the economy, unnecessarily bad outcomes. And so when that happens, I don't know. I'm one who believes that it could be a good part of 2024 before they even consider that.
So how long does the impact of 11 rate hikes, in your view, take? We've been waiting, talking about a year and a half, but we haven't really seen this downtrend in the economy just yet. I mean, serious downtrend.
Well, we may be seeing the lags, the lagged effects kicking in right now. So it'll be interesting to, in a month or two, to look back over this period and say, well, was it really a turning point in the economy's performance, and reflecting the higher rates, of course. But if things continue as the third quarter would suggest, which is pretty strong, then again, I will come back to the point that I think the rate hikes may not be over, and it may take more to slow the economy.
Dennis, what kind of a holiday season are you expecting? Clearly, consumer spending and the holidays are one of the most important items for the macro story and for a growth story that we're hoping for. So what would you be expecting going into Christmas?
I think the fundamentals suggest a pretty solid holiday season for retailers and for other parties that are selling into the holiday events. And the reason is people are employed. Today's report is not going to show a dramatic increase in unemployment, I'm sure. People are employed. They have confidence in their ability to remain employed, and therefore have income security, and they will spend. The U.S. consumer will spend if they're confident they're going to remain employed.
Makes sense. Do you believe that the strikes and the United Auto Workers strikes that we've been talking about will have an impact on the October number?
See, I don't know. To some extent, it depends on what week was the data accumulated. And my recollection is it's in the week in which the 12th of the month, 12th day of the month falls. So that's a couple of weeks ago now. And the strikes were going full steam a couple of weeks ago. So I would guess that there would be some reflection of that in the greater scheme of things, with almost 160 million people employed in the U.S. economy. The auto strike is not necessarily going to be decisive.
All right, we will leave it there. Dennis, great to get your insights. Thank you, sir.
Thank you.
Dennis Lockhart joining us this morning, a former president of the Atlanta Fed. We'll be right back.